Some of you should have your LLC taxed as an S-Corp, and some of you shouldn't. My name is Paul Vázquez with Tax Lab, and you need to become an ethical millionaire. The LLC versus S-Corp. Now, an LLC can be taxed as an S-Corp. You can make that election, but you first need to have an LLC. Now, an LLC doesn't help you save on federal taxes directly. Yeah. It can help you save on local county taxes because many counties do a business personal property tax. They'll tax the business on the property it uses. So some of these counties or cities, they can get really nasty about taxing grandma on everything she owns because she knitted doilies for Christmas gifts, or not Christmas gifts, but Christmas money. She made some doilies to earn some Christmas money. So you have to be. That's why an LLC can help to separate your personal assets from your business assets when working at the local level. However, on a federal level, having that LLC alone is not going to save you on taxes. You're still going to be taxed as though you were a sole proprietorship. That means you're going to have the income tax on that income. You're going to have the self-employment tax on that income. So you've got two taxes. When you have taxes outside, when you have income outside of a W-2 job, you've got to worry about not just income tax, but self-employment tax. Self-employment tax replaces Social Security and Medicare. So when you look on that W-2 on your pay stub, on that W-2 at the end of the year, you're going to see income tax, but then you see two more lines, Social Security and Medicare. You don't get those back. So the IRS says, and really it came down to people, you guys, and the American public didn't like the fact that business owners or self-employed people had a way out of paying into Social Security and Medicare. So you demanded, we must tax people who are earning money outside of a W-2. We must have them contribute as well. And so the self-employment tax is there. It's 15.3% of your income. And normally, if you have a W-2 job, that's split between the employer and the employee on that income. And so that 15.3% still comes out of pay on your W-2, but you just don't feel it as bad as on that self-employment income. So whether you're a sole proprietor, whether you haven't labeled yourself at all, if you get income outside of a W-2, you have two options. It's either earned income or unearned income, right? If it's unearned income, meaning that it's capital gains, right? You sold something, a stock, a painting. If you sold something, you could be liable for capital gains tax, which is a different tax rate. We're just talking about earned income in this discussion about LLC versus S-Corp. So now you go into business, whether you label it an LLC, whether you go get an LLC or you stay sole proprietorship, doesn't matter. You're still going to have to pay self-employment tax. You're still going to have to pay income tax once you've earned over $400 in that year. And so now you're going to have to report that on that Schedule C. So you're going to be taxed whether you've got its own an EIN, which is a tax ID number for the business, or not, whether you're operating under your own. Either way, you're getting those two taxes. You can do bookkeeping on either one. You can open up separate bank accounts depending on your banks with just a different name, and have that different name or even the same name be your business account. And you can separate the business assets or the business purchases and expenses from your personal. Just with a different bank account, that's a good start. You don't even have to have the LLC. Where the LLC comes into place is, number one, kind of a liability protection. You're beginning to separate out yourself from your business. And number two, it allows you to upgrade to an S-Corp with a look back. It's called a look back provision. You can do that for a tax year. You can start that right away. But without the LLC, you kind of have to start anew. You can't transition into an S-Corp and kind of backdate that to the beginning of the year. There's even kind of a 3-year look back, but they're a lot more tricky to work out because you still have to work out some taxes. So it allows you to kind of go for an upgrade if you need to in any given year. So it's smart that way, beyond the liability protection, beyond the protection against assets being taxed at the local level. So it's smart that way, but an S-Corp costs more money to manage. You have an additional tax return. You've got kind of higher standards to live up to. And on top of that, you're not saving when you convert from an S-Corp to an LLC. You're not automatically going to save on self-employment tax. You're going to save probably about half, maybe more, depending on that income level. Because as an S-Corp, you have to pay yourself as an employee. You've got to run some type of payroll or payroll process where you're paying yourself as an employee and having income and FICA, the Social Security Medicare, taken out of your pay. And so you don't have to do that with all the money, right? That would be as though you didn't even have an S-Corp, but you can do it on what they call reasonable compensation. The rest would then be counted as distribution or kind of a dividend that you paying yourself out of the company assets. You're still going to be with, no matter how much profit is at the end of the year, you're going to be taxed on that profit, whether you were taxed on that through your W-2, right? Because you're kind of withdrawing that counts as a business expense, but you're still paying taxes on it at the individual level right then and there. The other portion of the profits that you didn't withdraw through a W-2, you're not going to pay self-employment tax on that portion, which is why they require your W-2 that you're creating for yourself to be reasonable for the location, the business that you're in. Has to be reasonable. And then the rest of that you're not taxed on. So that additional 15.3%, not the income tax, just that Social Security tax, right? You're not getting that additional 15.3% on top of regular income tax that you have to worry about. That is kind of like a distribution. It is a distribution, kind of like a dividend, but it's because you're actively participating, it's going to count as earned income and not investment or capital gains. So should you just go out there and do it? Well, you've got costs, number one. And number two is that you're limited. One of the things about the S-Corp is you're limited to the amount that you can take out of the business. You can't take out more of the business than you've generated for that business. And so you might say, well, how can you do that anyways? Well, there's things like depreciation, where you can kind of accelerate out depreciation. So there's lots of things that can accidentally put you upside down on your equity, how much you've generated for that business as compared to how much you're withdrawing from that business. And you can get pretty aggressive with how you're withdrawing from that business. And so you really have to watch your basis, your inside basis is what they call it. How much value you've created for that business as compared to how much you're taking out. So you have to kind of keep an eye on that. You can't go upside down, or they're going to say you're not really a corporation. You're just an individual trying to make some self-employment, and now you're back to self-employment tax. So you really need someone to help guide you along the way, whether it's a right fit for you. It may or may not be. Go to lab.tax, click on advisory services so we can get you started. I wish you guys all the success.